Welcome to the Gold Newsletter Podcast, your bank of knowledge of investments, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives to increase your wealth monetarily and educationally.
This is Fergus Hodgson with the Gold Newsletter Podcast. Thanks so much for tuning in. We have a guest from Dublin, Ireland with us today. His name is Graham Neary, and he is my go-to man regarding financial statements. He is a charter holder of the CFA. He studied mathematics at Trinity College, Dublin, and he holds the FTSE. Well, he holds a FTSE beating investment track record. I mean, that's open for discussion. I haven't really examined that one, but he has the International Management Certificate, the STA Diploma in Technical Analysis, and he even completed some studies with the Mises Institute in Alabama. Graham, what an honor to have you on the show.
Oh, the honor is all mine.
Right, and I brought you in because maybe a couple of months ago you put on this course for people. Was that in Dublin, the course you put on?
No, I actually have a live course coming up in in London, but my teaching so far has been online, but I'm just moving into live teaching now as well.
Right. Actually, that I got confused there. You were advertising it a couple of months ago, but then you sold out right away. And the course is called Introduction to Financial Statement Analysis. So
yeah, that's right. Actually, what happened was there was a terrible blizzard which caused a lot of flights around here to be cancelled. So I had to postpone it for a little while, but looking forward to doing it in May in central London.
Great. So this is the predicament because many people are individual investors, as that includes listeners to the show. They're not accounting professionals, and they don't know where to start. I mean, there's just a mountain of data, of reporting to consider. And that's why you've been doing this. You can my hope is you can distill it down and at least give people starting points. So in this program you're going to offer, how do you go about narrowing down the field of material to focus on?
Sure. Well, I suppose the first thing to say is that you don't have to be an accounting professional to use financial statements. I'm not a chartered accountant. I've done the CFA, which is a financial qualification. If you look at great investors in the past, by no means are they all chartered accountants. You don't have to be an accountancy professional, but it does take a little bit of time to get used to financial statements. There's a lot of terminology. The lingo can be quite confusing, and a lot of companies present their results in different ways. So it's very easy to get confused, and the companies presenting their results, they often don't help. A lot of companies...
Are they trying to obscure things or make it complicated?
Well, sometimes they like to put the best foot forward for themselves, and so investors need to sort of have their they need to bring an air of skepticism to the table. But in terms of getting started, there's a lot of good resources online, and I'm trying to help in terms of I write reports fairly regularly online on Stockopedia and running my own newsletter, and I'm doing my bit to try and help people understand financial statements just through practically looking at companies. So my specialism tends to be in British companies, which they have a sort of a set of rules that they use that's a little bit different to the rules used by American companies, for example. But the best thing for people to do is to get experience and to browse good websites online, and don't expect to be good at it overnight. It takes a bit of time.
Right. I just think that applies to the field of finance more generally, that it really does take a period of investment of your time, particularly overcoming the jargon, because there's a language that in common parlance just is not used. It can be a barrier to many people. I've heard other advisors or commentators saying that this is almost too much for the individual investor, and that individual investors should not go about buying stocks one by one and should focus on either mutual funds or index funds or ETFs or other ways to go about it. Do you advocate that individual investors actually go about doing due diligence one by one in stocks?
I think, that is the main question which people need to ask themselves. And for most people who don't work in finance, in my opinion, it doesn't really make sense for them to buy individual stock because the amount of time required and the rather low likelihood of them getting it right means that they're just better off doing other things. But there are plenty of people who have some financial expertise or have a lot of interest, and maybe they get enjoyment out of it as well. So there's a sort of a non-financial reason to invest as well. When you have someone who has a decent pension pot and a bit of time and likes to understand what they're investing in and gets a kick out of trying to beat the market, there's nothing wrong with that either. Everyone needs to make that decision for themselves. I would say most people probably don't need to buy individual stocks.
What about, we actually had an episode, our last episode was on, within alternative investments, it was actually on junior resource companies, these companies that go out and explore for mining prospects. And in that field, the information is much less efficient. In other words, not all information is embedded in the price, right? There are more buying options on a particular level. How can I put it? You can find bargains because not all the information is available. It's not as fluid. These are smaller companies. That's the question I was getting to, really, which you touched on a bit. When it comes to the larger companies, my sense is that there are so many analysts doing this research all the time that you're going to have a hard time finding material that they've not already looked at and somehow getting a leg up on the market price.
Sure. So the smaller companies are more inefficient than larger companies because there are fewer people looking at them. And it's a sort of a historic fact that smaller companies tend to outperform bigger companies because of this fact that there are fewer people looking at smaller companies. It's more inefficient, so you can get a higher return, in exchange for the additional risk that comes with smaller companies. That's not to say that there aren't opportunities in big companies. Like, there are fantastic opportunities in big companies as well. And even though I'm known more as a small cap guy, I do buy some big caps as well because there are some, the thing about big companies is they tend to be, on average, the ones that beat out the others for in terms of competition. They're sort of the winners in the economy.
Right.
So, if you're buying a winner, like, the classic example is Coca-Cola. I mean, I've no idea if the share is a good investment today or not. Coca-Cola is a historical winner. So when you buy shares in Coca-Cola today, you're buying into something that's been a huge success. That can offer, huge opportunities as well. It's just going to be a lot more efficient. The pricing, the Coca-Cola share price is going to be a lot more efficient than the pricing of, some startup.
If we assume that going through one by one for stocks is a time-intensive process or labor-intensive process, you obviously send out your own newsletter, Gold Newsletter, the podcast. We are associated with a newsletter which focuses on mining stocks and other precious metals interests. So do you then advocate that people take in maybe second-hand information as opposed to just going to the raw financial data itself?
I mean, all things are good in moderation. So, I personally look at a lot of primary information in order for me to write my reports. I look at the primary information myself, but I'll certainly take into account secondary sources of information as well. I read other people's reports. I read other people's newsletters all the time. So, if you find someone you trust as a secondary source of information, as a source of ideas, then that can be a good part of your overall mix.
Right. And do you have any, I'm trying to think, how would one go about deciding that, whether you trust? Because the predicament is that, it takes a long time to build trust with a publication. And I was speaking with Mark Skousen maybe a year or two back, and he was just saying that 20 or 30 years ago, when he first was getting rolling, there were so many fewer publications out there, and he just said now it's just awash with all these digital newsletters and fewer people want to pay now. So what has been the evolution in both the quality and content of newsletters at this point of time?
That question is possibly beyond me, to be honest. I mean, I'm offering a free newsletter to people who follow my work online, and so I'm not currently selling a newsletter. So,
but why do you give out free advice then?
Oh, sure. Well, it's more of a hobby for me at the moment. But my main activities is just running my own investments and writing some reports on websites, on various online websites. But I may expand my personal activities over time. But my personal newsletter is really just a way to stay in touch with people who've expressed an interest in my analysis.
Sure. One other interesting element about taking in more investment information, which somewhat surprised me, is that often it can be counterproductive because it can lead you to make more trades rather than fewer. And this is just referring to a comment I heard on a podcast noting that there was, I need to dig up this research report, but basically there was a study which was referenced on a podcast, which I should have in front of me. But basically the finding was that often the portfolios that did best happened to be of people who had died. Right, so no one had been playing with them or wasting money. And that is a predicament that when we get more heavily involved, our emotions come into play. We may want to misinterpret the data or interpret it as we see fit. How much credence do you give to the idea that we should just take a more hands-off approach and not devote so much time to trying to outsmart the market?
Well, it really depends, Fergus, on how much time you're willing to put into it. So if you don't have the time to follow the financial markets on a regular basis, then, it's just not for you, sort of stock picking. Maybe you could, or maybe in very limited quantities. But even for those of us who are following financial markets and companies, as our full-time profession, we should definitely take into account the fact that, dead clients have outperformed living clients, according to that anecdote, which I've also heard that anecdote as well. And it would not surprise me at all if it was true, because there are massive frictional costs in trading. And so every trade results in an upfront loss in commission and in spread, and then you have the opportunity cost of not being invested. So one thing that people like myself try to do is to be very sort of methodical about when we buy a position, and then to try to hold on to that position for as long as possible. So if you're making a long-term investment, you don't need to have a target price to sell it at. You can just say, I'm holding it. I like the company. I feel like I've paid a reasonable price for it. So that's it. I'm involved now. If you look at the track records of some of the best investors, they are long-term investors. In a British context, Terry Smith has put out his slogan of being buy good companies, don't overpay, and do nothing. That's his 3-step plan. Warren Buffett's ideal holding period is forever. So the best investors are holding companies for a really long time. So if you go into investing with the philosophy that you don't plan to sell, you'll probably do better than someone who's chopping and changing the whole time.
Right. And that maybe puts me in a bit of confusion, because you have this STA diploma in technical analysis. Do you want to contrast then, if that is the case, how much validity, let's say we move beyond the strict public accounts or public data, and we actually move to market data or market trends, how much time do you devote to the two, relatively speaking, to market trends versus actual published data?
Okay, well, I need to talk a little bit about technical analysis, because I had experience in technical analysis at the beginning of my career. I have a huge respect for the discipline. There's a lot of usefulness. There's a lot of usefulness in technical analysis, but I don't think you can bring technical analysis to fundamental analysis and combine the two I think some people do that, but it's a very difficult thing because ultimately technical analysis is about trading. So you have to make the distinction between, am I a trader or am I an investor? If you look at the big picture, what is a trader doing? What is the economic purpose of a trader? That person is a liquidity provider. They're providing demand when there's excess supply. They're providing supply when there's excess demand. They're buying low and they're selling high. They're selling high and they're buying low. That's a trader. There's a huge difference. There's a complete difference between that and an investor. So an investor is buying things because they want the dividend yield, or it could be they want the interest payments, or they want the asset for its fundamental characteristics. So it's a completely different approach. So even though I qualified in technical analysis and I've used it, and I still look at technical levels in terms of entry points, that doesn't make me a sort of a technical trader. Does that sort of help to give you the bigger picture on how technical analysis sort of fits into my framework?
Do you want to rub elbows with the best minds in the precious metals and mining industry? You can on the Money, Metals, and Mining Cruise from May 28th to June 7th, 2018. Explore the jewels of the Mediterranean while discovering the latest strategies to successfully invest in precious metals and mining stocks. It's a perfect blend of adventure, learning, and luxurious leisure aboard the Crystal Serenity, always a popular destination. Cabins will sell out fast. Call cruise experts at 800-797-9519 to learn more, or visit our website, goldnewsletter.com/cruise.
So you just, in your own life, you have almost separated those two areas, that in one period of time you were focusing on trading and technical analysis, and now you're focusing on investment and fundamental analysis, and you just see those two as going hand in hand.
Yes, like I see them as very distinct disciplines, and it's like people say there's more than one way to beat the market, or there's more than one way to make money. In the stock markets, you've got people using a lot of different strategies to try and make money, and some of them work and some of them don't. But a lot of the differences between the strategies are to do with time frame. So if you're trading, then you've got a shorter time frame. You're trying to buy just before the big heavy institutions start buying. And then when the big heavy institutions come in and push up the price, that's when you want to sell. So the trader is like nipping in between these sort of big movements, whereas the institutions and the fundamental investors, they're not trying to sort of just be that liquidity provider. They're trying to actually own the asset. So they care about the asset's fundamental characteristics. And that's what a fundamental investor is. That's sort of what value invest is, when you want to own the asset. And you don't really care about trying to sell it to somebody at a higher price. And there's that old phrase about, I don't care if the stock exchange closed for 10 years because I'm happy I want to own the company. So that's what fundamental investing is. That's what value investing is. And you can't mix that with technical analysis.
I see. In your course, you break it down into the different statements, financial statements, income statement, balance sheet, cash flow statement, financial ratios, accounting red flags. If you say you don't, as a general rule, recommend that individual investors go through one by one with stocks, who are the people that should be consuming this material or taking your class, for example?
Well, my opinion is that most people don't need to look at individual stocks. But there are some people who want to and who are good at it or who have an interest in doing it. And so my audience is those people who do want to. I train people who maybe have some previous financial expertise, or they have a very strong interest. If someone tries to beat the stock market, they may find that they can't, and they may find that the best thing for them to do is to not try to do it in the future. Like even I know it's easy to talk about Warren Buffett all the time, but He himself said in his early letters to shareholders that if he couldn't beat the market, he'd go and find something else to do with his time. That's what people need to try and figure that out for themselves. Are they able to beat the market? And if they can't, do they want to keep trying? It's an entrepreneurial decision. It's a decision about am I a good businessman? Am I a good investor? No one is ever going to have 100% certainty that they will beat the market. I don't beat the market all the time. Nobody does. But, people have to decide this for themselves.
If people, aside from taking your class, if you happen to be in the UK or in Ireland, I guess that would be close enough. How should people, aside from just going on looking on online programs, do you have any online programs you recommend that people just go to that I'm not sure the best way to process these. I took accounting at university, but my sense is it just went in one ear and out the other and didn't really carry a lot of meaning. So I assume that people will learn more if they take in the material in a context of when they are investing or when it has more meaning to them.
Yeah, so if someone's interested in the stock market, one thing they can do is start small. So if you have so this isn't financial advice, but I'm just giving a sort of an opinion here. Suppose somebody has a financial advisor and they have a diversified portfolio with ETFs and mutual funds and all the rest of it, but they want to see if they can pick stocks and beat the market that way. They don't have to put all of their portfolio into it on day one. They could paper trade for 6 months or a year and just see, sort of accumulate knowledge about various companies, put some markers on, keep some records and say, I thought the stock looked like a good buy there. And after a year, did that sort of come true or not? Or did the story continue as I expected it to continue? And then if they want to actually buy some stocks, they can do that with, some portion of their portfolio. It doesn't these things don't have to be all or nothing. The other great thing about sort of modern investing is that you can have conversations with people online. I get dozens of comments on my reports online, and people have so many forums they can go to, very active forums where they can express their opinion and get feedback. I've told some of my clients who feel a little bit nervous about their investing ability to at least go and write down their opinion. And even better than writing it down for yourself, publish it. People love correcting other people. People will tell you if you're wrong, and they'll help you improve. So investing is more of a team sport nowadays. So that's another really good way to improve.
Yeah, it's a beautiful development that we have. For example, I use the Reddit forum. I'm not sure if you're on there, but there's an extremely active forum on Reddit, just Reddit Finance. And I think they have a discussion every Monday. I think it's called Moronic Monday or something like that, or Moron Monday, where you just put up your questions, no matter how dumb they may seem, and everyone will jump in and try to help you out. It's an amazing development. One of the challenges, though, is that we're entering a new era, of course, in terms of alternative investments. I think of crowdfunding, for example. There are also alternative platforms for loans now. There are platforms now that basically give peer-to-peer loans. It's like the Airbnb of loans. And I just have a hard time getting my head around these platforms on how you would actually assess their risk or whether the return is appropriate. Have you paid much attention to these new platforms?
Yeah, I know what you're talking about, sort of peer-to-peer lending and other similar platforms. So they would generally be quite high risk, I think. They would not be, you'd have to look into each specific case, but my understanding is that in general, they would not be diversified. You'd be choosing a particular company to invest in, or particular sort of security. So you'd have to do the same due diligence there that you would do for buying, a share on the stock exchange. The other thing I might say about peer-to-peer lending is that we're in a period of extreme low interest rates. So I think some of that phenomenon may be attributable to the fact that people are desperate for interest. They're desperate for yield.
They're willing to take higher risks just to try and squeeze out a bit more.
Absolutely.
So it may even be driven more by the lenders than by borrowers.
Yeah, well, it's both. The borrowers are desperate for income. But, with bank accounts, offering such weak returns or even negative returns. Lenders are desperate for some income, and borrowers will happily take that. They'll happily take in more financing.
It is bizarre, to be frank, because, for example, I received an email from my bank in the United States offering 1.49, I think, or 1.5% interest on a deposit of $50,000. If you want to put down $50K, you'll get this 1.5%. And they were saying how this is such a high rate and so good, and you want to get in on it. And if you don't have $50,000, well, I think you get 0.99 or 1%. And I just thought, we do live in a crazy era where that sort of return, which is less than inflation, can somehow be appealing to people. Do you want to just give a quick comment on why people might just say the returns, I'm willing to accept these lower returns? Well, maybe the risk is too great in the stock market or in these alternative platforms, and I'm willing to just sit my money at this time. What would motivate people to do that?
Well, everyone has a different time horizon. Some people, they're saving for something next year and they don't want any risk, or maybe it's their life savings. They're not going to have a chance to earn it again, so they don't want a loss of capital. There are all these other factors like someone's financial expertise. If they don't have financial expertise, they have a low risk tolerance, they're unable and unwilling to take risk. Everyone's got their own position, own situation. So some people have to just, for their own personal reasons, accept bank returns. Now, maybe their financial advisor can come up with, a way to help them, but it's a fact that some people are going to just have to take these poor returns, and that's the wealth transfer from savers to borrowers, which occurs in a period of suppressed interest rates.
I see. The website for Graham is just grahamneary.com. Go to goldnewsletter.com/podcast for the show notes. And Graham is active on Twitter. He has an irregular, maybe every couple of weeks or so, or a month, he will send out a short e-newsletter, which I receive. And do you want to point to any other source? Oh, you said Stockopedia. Do you have a particular archive on Stockopedia?
Yeah, so I co-write the small cap value reports with Paul Scott on Stockopedia. So if you just search for Stockopedia, you'll find that, or you'll find it through links on my Twitter. That's a great place for commentary and analysis on UK stocks. In fact, they have a wide range of international markets covered there as well.
Excellent. So Graham Neary, I appreciate your time, and I hope listeners get in touch with him or follow up with his materials. I personally follow them, so I'm glad to have him on the show.
Thanks. It's been a pleasure.